Welcome to Talk Tickers. It is Sunday, January 25, 2026. This is the Deep Dive.
Hello, everyone.
Today, we are deliberately looking past the big flashy headlines.
Right, not the $100 billion AI data centers.
Exactly. Everyone is screaming about those. We're looking in the other direction at the plumbing, at where the smart money is quietly making moves in the background of the global financial system.
That's right, because while everyone's chasing GPUs, the real operators are watching the bolt-on acquisitions.
The small plays.
The small strategic plays. They tell you exactly where cash flow is heading, 3 or 4 quarters down the line. It's not sexy, but it's where the alpha is.
And today's subject fits that mold perfectly.
Yeah.
We're looking at HCLTech.
The Indian IT giant.
They've just signed a definitive agreement to acquire a Singapore-based firm, Finergic Solutions. Now, if you just glance at the ticker, this looks like what looks like nothing.
A rounding error.
But when you dig into the geography, the specific capability, the timing, it tells a much, much bigger story about the future of global wealth.
It's a classic signal flare deal. It's not about buying revenue. It's about buying a very specific high margin capability in a very specific zip code. It's what I call the Asian capital axis.
I like that. So here's the plan. First, we'll break down the numbers because there's a hidden detail in the P&L that just changes the whole equation.
A critical detail.
Then we'll get into the wealth tech stack. And finally, our not financial advice segment where we build a trade around this. So let's start with the hard data. What are we looking at here?
Okay, let's strip it down. The buyer is HCLTech. For context, they're sitting on roughly $14.5 billion in revenue, a massive company.
Like ocean liner, yeah.
The target is Finergic Solutions. The price, 19 million Singapore dollars.
Which is about what, 14.8 million US?
Roughly, yeah. Just under 15 million US.
Hold on. A $15 million deal for a $15 billion company. That is, that's 1/10 of their revenue.
It is.
Why are we even talking about this?
Because of what they're buying, not how much they paid. Let's stick with the math for a second. It's an all-cash deal, 100% equity, closing by April 30, 2026.
Okay.
Now, Finergic reported 12.6 million Singapore dollars in revenue for fiscal 2024.
So they're paying about 1.5 times revenue.
In this market, that seems reasonable, almost cheap, really.
It's very reasonable, but look at the profitability. They posted a profit after tax, a PAD, of 2.9 million SGD.
So that's a net margin of over 20%.
Over 20%. In the services world, that is a very, very efficient operation. They're not buying a project, they're buying a machine that prints cash.
Well.
But, and this is the key, there's one line item in the filing that makes this whole thing fascinating.
I think I know where you're going with this, the related party disclosure.
The related party disclosure. Out of that 12.6 million in revenue Finergic reported,
yeah,
5.1 million of it came directly from HCLTech.
Wait, get this straight. Almost 40% of their business was already HCL. Correct. So think about what that really means. HCL was subcontracting work to them. Finergic was a vendor. HCL would win a big banking contract, realize they needed some really niche expertise.
Specialists.
And they'd hire Finergic to come in and solve the hard problems.
So when HCL buys them, they're not just adding top-line revenue, they're actually eliminating a cost.
Precisely. They're taking that $5.1 million of vendor spend and converting it straight into internal margin. It's immediate accretion. You just stop paying the markup to the subcontractor.
You bring the talent in-house.
Yeah.
And that revenue flows straight to your own EBITDA. It's a consolidation play. Very disciplined.
It tells you they're not just chasing growth at any cost. They're optimizing their existing business. And it's defensive. It removes the risk that, say, Infosys or Wipro buys Finergic instead.
Ooh, that's a great point. You can't have the critical experts on your project suddenly working for the competition.
Exactly.
Okay, so that's the what. Let's move to the who. Give us the profile on HCLTech and this boutique firm, Finergic.
Well, HCLTech is the 3rd largest IT services company out of India. CEO C. Vijayakumar has this strategy they call supercharged progress. But really, compared to their peers, they're very heavy in engineering and R&D services and just massive in financial services. They run the backbones of banks.
And Finergic. You call them snipers.
They are a boutique firm founded in just 2019. We're talking about a small team, maybe 80 consultants, but this isn't a body shop model.
Right, not fresh graduates.
No, the average person there has 12 years of business knowledge and 15 years of tech experience.
15 years. In IT services, that's a lifetime. These are the veterans.
These are the people you call when a bank's upgrade is failing and you need someone who actually knows what a complex settlement instruction is. And they're specialists in a platform called Temenos.
Okay, let's pause on that. Temenos. We hear that name in international banking, but not so much in U.S. retail banking. What is it?
Think of Temenos as the iOS of banking for most of the world. In the U.S., banks often run on really old, custom mainframe systems.
COBOL code from the 70s.
Right. But in Europe, Asia, the Middle East, Temenos is the dominant core banking software. It handles accounts, interest, transactions. If Temenos goes down, the bank stops. It's the central nervous system.
So HCL's buying the mechanics who know how to fix the engine while the car is flying down the highway.
Perfect analogy. And they've done this before. This is their string of pearls strategy. Go back to 2022. HCL bought a Swiss company called Confinelli AG.
And Confinelli was also a wealth management consultancy, right?
Okay.
But they specialized in Avaloq.
Exactly. Avaloq is the Android to Temenos' iOS. And where was Confinelli based? Switzerland.
Finergic is based in Singapore.
But not just Singapore. They also have a presence in Luxembourg and Switzerland. If you're in wealth management, those three, Singapore, Switzerland, Luxembourg, that's the Holy Trinity. It's where the world's offshore wealth is booked.
So let me connect these dots. HCL now owns a specialist in Switzerland for Avaloq, and now a specialist in Singapore for Temenos.
You've got it. They are building a corridor. They are effectively trying to corner the market on implementations and upgrades for the two biggest software platforms used by private banks globally.
So whether you're a bank in Zurich with old money or a family office in Singapore with new money, HCL wants to be the only call you have to make.
That's the play.
But why now? What's happening in January 2026 that makes this so urgent?
It's a great wealth transfer. It's not abstract anymore. It's hitting balance sheets. Trillions of dollars moving from boomers to millennials and Gen Z.
Okay, but how does that change the software? A dollar is a dollar, right?
Not anymore. The user interface for money has changed completely. The old way, golf courses, paper statements, a quarterly call, that's dead.
When this generation wants an app?
They want an app, they want a real-time dashboard, they want robo-advisory, they want to see their crypto next to their municipal bonds. And the banks are terrified because their back-end systems are 40 years old. It's all spaghetti code.
So they can't just build a shiny new app on top of a dusty old core.
It breaks. And that gap, that's where Finergic lives.
I saw in the notes they have something called an upgrade blueprint. Sounded like marketing fluff to me.
It's actually their IP, and it's critical. See, the old model was selling hours, time and material. The slower I work, the more I get paid.
The inefficiency tax. Clients hate it.
The new model is products and platforms. You sell an outcome. Finergic has software that scans a bank's code and maps the entire minefield before you upgrade.
So HCL isn't just buying 80 people. They're buying a proprietary map that makes upgrades faster.
Which is a massive competitive advantage. If HCL can go to a bank and say, we can upgrade your Temenos stack 30% faster than our competition because of this tool, they win the deal. And the upgrade is the wedge. You get in with the upgrade, you stay for the 5-year maintenance contract.
Let's talk integration risk. Big company buys small, nimble company, crushes the culture. Is that a risk here?
It's always a risk, but I'd say it's very low here. Remember that revenue overlap?
40%.
These teams have been working together for years. They've been in the trenches on the same client calls. The courtship lasted 5 years before the marriage. This is just formalizing a relationship that already works.
Okay, let's pivot to market impact. The ticker is HCLTech H. Is this going to move the needle on the stock?
Short term, no. Mathematically, it's just too small. A $15 million deal is a drop in the bucket. The stock won't spike tomorrow morning.
So why should our listeners, why should investors care?
The signaling value. The market should read this as HCL doubling down on that Singapore, India, Switzerland wealth corridor. It shows they're defending their moat in financial services.
How does this compare to what, say, TCS or Infosys are doing?
Very different. TCS has their own product, BNCS. They want banks to rip everything out and install their software. It's higher risk, high reward.
And HCL's approach?
HCL is taking the Switzerland approach, no pun intended. They're agnostic. They're saying, use Temenos, use Avaloq. We don't care. We just want to be the ones who implement and run it.
The picks and shovels play.
Exactly. And that's a much stickier business. The CIO is never going to fire the only team that knows how the legacy code actually works.
So it's a solid, smart, strategic move, not a home run, but it keeps the scorecard moving.
It's just good business.
All right. We've covered the sensible stuff. Now it's time to take off the sensible tie for our favorite segment.
Let's do it.
This is not financial advice. I repeat, this is not financial advice. Do your own diligence. But if you had to construct an outrageous but plausible trade based only on this news, what's the pitch?
I'm calling this one the Golden Corridor Arbitrage.
Love the name. Break it down.
The setup is this. HCLTech now basically owns the upgrade path for the software used by banks routing the world's old money Switzerland and new money Singapore. They own the toll booth.
They control the friction points.
Okay, and regulation is getting tighter. Basel III, anti-money laundering. Banks must upgrade. It is not optional. It's regulatory survival. HCL owns the team that knows how to do it.
So what's the trade structure?
It's a three-legged stool. Leg one, you go long HCLTech. That's the safe, steady compounder. Leg two, you go long Temenos, the software vendor. Ticker, TEMM on the Swiss exchange.
A derivative bet on the software itself.
Right. And leg three is the kicker. EU short regional U.S. banks.
Ooh, that is spicy. Why?
Because they're stuck. They are sitting on completely different legacy systems. They're missing the Asian wealth boom. They are fighting for checking accounts in Ohio while the real margin expansion is happening in cross-border wealth management.
Brutal. I see the logic, though.
It's the reality. This deal highlights that growth is in global wealth, not domestic U.S. retail. The regional banks have the same tech debt, but none of the growth tailwinds.
So you're betting on the friction costs of moving money in Zurich and Singapore and betting against a stagnant U.S. banking model.
Exactly. You're not betting on IT services. You're betting that the rich get richer and they need better software to manage it. HCL is just the plumber fixing the pipes for the billionaires.
And plumbers always get paid.
Plumbers always get paid.
So to wrap it all up, HCLTech buys Finergic for about 15 million US cash. Closes the April 2026. It's a small, smart, margin capture deal that tightens their grip on the Asian and European banking tech stack.
It's a signal that HCL is playing the long game in that wealth corridor.
Thank you for listening to Talk Tickers. If you enjoyed this deep dive, make sure you subscribe. We'll be back with the next big market move you need to know about. Until then, keep watching the tickers.
Go away, everyone.